You don't want to miss this episode. I'm talking to Erwin Szeto, rock star investor, real estate investor from Ontario, how he's transitioning from investing in Canada to investing in US properties. What are the tax implications? Where to look for properties? How do you manage it? We're going to dig into all that. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and I'm excited to have a great guest today. Erwin, been following you a long time. Erwin Szeto, welcome to the show.
Thanks for having me.
All right, so Urban, your company, I Win Real Estate, and you've been in the real estate world in Canada for a long time. You've had successful podcasts, you've been a successful real estate investor, but you really, in the last number of years, have kind of transitioned to the U.S. and I'm fascinated to learn how you did that and what are the things we can teach our listeners. So, what was the tipping point for you to say, okay? Maybe I'm done looking for new properties in Ontario, and maybe there's other avenues in the States I can look at. What was that tipping point for you that made you decide to look outside the country?
The tipping point was like a perfect storm. Like the market was crap. The LTB is still broken, and it was broken. And even before the pandemic, it was still 3-4 months to get a hearing. So, in the context of North America, that's pretty horrific. So there's the challenges we had locally. And then it was actually a friend of mine, the mortgage broker I've been using for years, Scott, who's out of Lynn City, out of Windsor, Ontario. He's dual citizen. So he opened up a mortgage brokerage in the States, and he's like, Erwin, I can get you U.S. mortgages now. And what was he had one lender when he started. Now he has like 4,500 lenders to shop
Wow.
deals in the U.S. from Canadian investors. So that was the biggest hurdle always for me, was because unleveraged real estate doesn't make sense. You're better off buying an index. But once you get mortgages on investment properties, and also we can do it scalable. It's 10 times easier to get financing in the States versus is here in Canada on income properties, even though we're Canadians, as foreign investors. And then the other part of the perfect storm was a company called Share reached out to me, and they asked me to send them clients. And like, well, what do you do? And they said, well, we're asset managers. So we deal with you end to end. We handhold you through the entire process, including entity creation, deal sourcing, due diligence, closing the property. We manage the manager. We are from the institutional world. So end users like yourself as the investor, you get to invest just like an institutional investor, except we only charge fees. We don't take equity, right? Which is different than a REIT.
Wow.
Any REIT we buy shares of, and the REIT always has equity. Versus here, I am the direct owner. The mortgage is mine. The title is mine. I get all the upside, and I get to be a U.S. landlord without doing any of the heavy lifting. So my mind was just blown.
So they handle everything?
Everything. I don't do anything. I still have to get my own mortgage, which is still highly advisable. You don't let everyone else touch your mortgages, but I do the mortgages. But again, I was capped here, even as a professional real estate investor with a significant track history. I was capped here. I couldn't get more mortgages, and with the strategies that we do here as well, they're just so hard. Like for a basement apartment, like retail basement apartments, like $150,000 to do a basement apartment in Canada. My clients are buying houses for like 90 grand, 155,000, 265,000 US. And we get better yields. We get better cap rates, and the landlords have all the rights basically. If a tenant doesn't pay rent, they're gone in 30, 60 days. And again, the company I work with now, Share, like they handle everything. I don't have to do anything.
So when you say handle everything, are they doing the property management? Are they doing
Yeah,
like the paperwork? Are they finding the
everything.
tenants, screening the tenants, collecting the
Yeah.
rent?
They're the asset manager. So, which for most landlords, they are the asset manager because they manage the property manager. So Share manages the property managers. And these are all institutional grade property managers. So the same folks that the REITs use.
And they charge you, they charge you percentage of rent, or do
Yeah,
they
percentage
charge
of rent. Yeah.
percentage of rent?
The property managers charge a percentage of rent. We at Share, it's a pass through. It's a third party. Uh, and then Share, how we make money is we charge an acquisition fee, either 7,500 US or 3%, whichever is higher, and we take an asset management fee, which every REIT does, except we do not take equity or performance fees, which every REIT does. So this is the sweetest deal I've ever seen, and this is the benefit of advancements of technology and AI, that we're able to do this for everyday investors. Because an everyday investor can afford, should be able to afford a $90,000 to $155,000 to a $265,000 house in landlord-friendly USA.
So if a Canadian were to buy a $200,000 house in the USA, walk
Mhm,
through how would they get, how much down payment would they be required to do? How would they get financing? What percent financing
mhm,
could they get over
mhm,
how many years?
mhm.
And kind of how a typical deal would work, like in a $200,000 home.
Sure. Let's use a pretty clean and simple example. So we just had a client buy a brand new house. We bought it directly from the builder in Huntsville, Alabama, 279, and the rent will be $1,900. So very vanilla easy. Down payment probably need around 30% in order to make that thing cash flow. It's new, so there's minimal renovations. It'll probably like 5,000 just to do like window coverings and appliances. That's how it works in the States. Um, and so then we help our client create their U.S. entities to own the property, including their IRS number, their EIN, their employer identification number, so they can file taxes. Uh, Again, we source the deal for them. We coordinate the due diligence, like home inspection, property manager inspection, which includes quoting the rent. We help them to closing. Client closes on the property. If they want us to, we can pitch their deal to about 1,000 lenders ready to lend to foreign investors. And these mortgages are all commercial style, so it's this debt service coverage ratio mortgages. So the deal qualifies for the deal for the property for the mortgage, not them individually.
Even if it's a 1 or 2 unit, it's still going to be the
Oh yeah,
deal
even with one
qualified.
unit. Yeah,
Doesn't have to
yeah.
be 4, 5, 6 units.
No, doesn't have to. Yeah. So for those who are self-employed or capped out on mortgages here in Canada, that this is perfect. uh, yeah, we manage the manager. And for anyone who's been a landlord for long enough time, they know property managers they come and go. So again, that's shares responsibility to manage the manager, turn them over when necessary, right? And so this is easy as possible for our clients. Again, because we're doing things on such scale, technology enabled, even our clients' bookkeeping is done for them. So the property bookkeeping is done for them. So at the end of the year, all they need to do is download their tax document from our client portal, their tax documents in their bookkeeping file, and hand it over to their accountant to minimize their accounting costs.
Okay, so let's stick with that example. So that house for 279 cash
Mhm.
flows. Let's say there's 5 or 10 grand of positive cash flow a year. How are taxes going to work for a Canadian citizen owning a property in the U.S.?
So I'm not an accountant. I just happen to have married one. So folks need to understand Canada has a tax treaty with the Americans, so there is no tax savings, right? Whatever we pay, as long as you set up your entities correctly, which we do, because the CFO of Share is a tax specialist, both Canada and the U.S. She's a CPA, both Canada and U.S. So if you set it up properly, whatever income you make, you pay taxes on. You have to pay the U.S. state, the U.S. federal government, and then the CRA will credit you for whatever you paid them, and then you pay the balance to Canada. But take a step back. If you're cash flowing that much, you should probably re-leverage and buy another property.
Yeah. Okay, and as far as return of capital not being taxed, all that, is that all going to be the same? What
All
are
the
the
same.
other tax
All the
differences?
same. The vast majority of our clients are passive investors, so they're set up the same. So what I'm referring to is what the structure for a passive investor and the tax treatment for a passive investor, as long as they're Canadian paying taxes to Canada. And I'm just assuming your listeners are Canadian.
Yep, absolutely. Okay, so when you were transitioning to the U.S., you mentioned a couple big obstacles, but what were the big obstacles you faced to shift from the Canada market to the U.S. market, and like what did you do to overcome that? Because I got to think there's got to be all kinds of challenges in a country you're not as familiar with.
hmm
You don't know the markets as well. You
hmm
you obviously know the Canadian market inside and out. What were some of the big challenges going to the U.S.?
I think I have these discussions every week with Canadians. It is like Twilight Zone, more for American looking at how we do a business up here. So anyone who knows me knows I research heavily. I value other people's opinions. I always follow the money. So I always try to learn from many sources. So for example, when I met with the property manager in Atlanta, I explained to him how we invest here. And he said to me, "You mean your house is $1 million, like a duplex? Your duplex is $1 million and they don't have to pay you rent?" And like, yeah, that's how we do business up here. And then, oh yeah, and you still pay the property manager if you have vacancy. Like, yeah, yeah, yeah. It's like, then there's no incentive for the property manager to rent through the property. Like, yeah, yeah, yeah. So when people understand, once, if anyone who's been around for a little bit understands what our risks are here in Canada, especially like BC or Quebec or Ontario, how everything's in favor of the tenant, then how are you not motivated to go look somewhere else where investors and landlords are welcome and the rights are in their favor, and you can scale your mortgage 10x, right? So yeah, so actually after that, after understanding the landscape of understanding the business case that is much better to be an investor in the States, the honest hard part was there's just so many good markets to invest in the States versus in Canada you have very, very few markets to invest in, right? So then it's more like kid in a candy store, which I'm happy about because I love candy and I'm a real estate geek.
So how do you identify those markets that you think are the best fit at in today's environment in the U.S.? How do you identify those markets?
So I did my own independent research. For anyone who's been following the U.S. economy, they know that it's been absolutely ripping. The U.S. economy is completely outpacing Europe and Canada, all the rich countries. They're eclipsing China. China's having lots of fundamental issues. And then just doing a lot of reading the news, and also not reading the headline news. I don't care. I really don't care that much about the election. I'm more interested in what kind of investment and job creation is going on in the States. So, for example, like TSMC, the world's largest outsourced microchip manufacturer, is building 3 plants right now in Phoenix, Arizona. $65 billion investment to create, I think, 6,000 manufacturing jobs, and they all pay a lot of money, right? Texas economy is growing incredibly. They also have Samsung and Texas Instruments building manufacturing plants for microchips as well. And for if people don't believe in AI and supercomputing, then just ignore me. Fortunately, I do. Maybe not fortunately, but I do believe in these things will happen. But yeah, so the Texas economy is absolutely growing. They also have lots of automotive investment. I bought my own house in San Antonio, Texas, where Toyota is investing another $531 million to create another 400 jobs where they manufacture the Toyota Tundra. Right. So anyone who's been in America knows the Americans love the Toyota Tundra. So, and then also the chief investment officer of Share, the company I do work for as well, he used to run a U.S. portfolio for Starlight Investments. Starlight Investments is Canada's largest apartment building owner, 56,000 apartment units I believe they currently own. But he managed the U.S. Portfolio. That was $7 billion under assets under management, 20,000 apartment units in the States. So I have that resource available to me. So I just ask him, these are my requirements. I have properties in Ontario still that should appreciate well, but I'm missing cash flow. What do you recommend? And so I look for an intersection between, a super crazy expert's opinion versus my own research. And my research has verified what he's told me.
So you find a market based upon jobs, future, where you think it's going,
Yeah,
and then I'm assuming you got to pair that with the regulatory environment in the state because every
yeah.
state is going to have different. So what states are you seeing that you like the regulatory environment, or is it most states in the USA versus Canada where we've got some challenges?
Again, it is like a kid in a candy store. But my conversation with Dimitri, the chief investment officer of Share, was he narrowed it down pretty quickly. Kansas City, Missouri, which is on the state as well. So there's Kansas State as well. Kansas City, Kansas State. That's one city, but it's border town. We have a lot of clients buying in Memphis, Tennessee, the suburbs of Atlanta, Georgia. Texas in general is pretty fabulous, and Little Rock, Arkansas. So again, we have clients buying in all these areas, and also there's several cities in Alabama that make a lot of sense as well. And for anyone to do some basic due diligence, even on ChatGPT, like those are all business, for, like high level, they're all attracting historic amounts of investment, including foreign investment, to create thousands of manufacturing jobs that all pay a lot of money in all affordable cities as well.
I noticed you didn't mention the state of Florida, which a lot of Canadians do invest in. Now, we're coming off 2 massive hurricanes and all kinds of other challenges in Florida. Is Florida overpriced? Is it the storms? Is it the regulation? Why not Florida?
So what we tell our clients interested in Florida is we can't predict what your insurance will be next year. So, from an investor or a business owner's perspective, if you can't predict what an expense will be the next year, I think that's kind of a red flag.
Mhm.
Versus there's all these other parts of the country that do not have natural, do not have climate change risk on the same level, right? So, for example, my property's in San Antonio, Texas. They've only ever had 3 hurricanes in its entire history, right? Tampa Bay, which is normally considered safe, just got hammered by the one of the worst hurricanes in history. Yeah, from a risk tolerance perspective, it doesn't seem to make sense. And then anyone looking at the trend, just anyone can just Google Florida insurance and read the news, and it's all very bad news.
So you mentioned property management earlier about how they don't collect money unless the tenant is in. What are the other differences between property management in Canada versus the USA? Because those of us that are landlords, we've all had property management challenges.
Mhm.
What are there any big differences?
The big difference is how many big property managers are in the states. Like here locally, there's almost none that are available for mom and pop investors to hire. Right, all the big ones are generally just they work they work internally for their own REIT. Right, so for example, the property managers that we use in the states, they will have like 3,000 houses under management in the same city as where our properties are. Right, you don't see that scale in Canada. Well, first of all, Canadian cities are generally quite small. Right, there's only 3 cities in all of Canada with a population over 2 million. Right, I think the states have somewhere over 50 or something like that. And then if people want to invest in a big city in Canada, you're stuck with the Toronto, Vancouver, which are crazy overpriced, or in Montreal, which all speaks French. So again, in the states, way more options. And then because with the property managers in the states, because they are so large and have such scale and efficient operations, everything is so streamlined, and then everything is generally cheaper in the states. Repairs and maintenance are cheaper. Leasing fees are cheaper. We at Share, we have our own master insurance plan as well, so our clients get cheaper insurance. So it's cheaper to be an investor in the states. Labor costs are low. Labor and material costs are lower in the states in general than Canada as well.
What about I know in Canada, you've built an incredible network up or a lot of real estate investors have, where you've got a real estate investor, you've got the property managers, you got a whole team, you got
And
mortgage people
wholesalers too.
and wholesalers. Yeah.
Yeah.
How do you go about building a network in a new country?
The way I did it was I hopped into someone else's ecosystem, which is this company Share. So full disclosure, I am head of business development for Share in Canada. They pay me, and I have equity in the company, and I'm buying more shares. So full disclosure. So folks can do what I did and make it really easy. And I think for the vast majority of Canadians, that's what they should be doing. Because in working with clients since 2010, all of them wanted to make money passively and they wanted cash flow. So I don't see either of those options available in Canada. If they want to go build their own team, they can absolutely do so. Again, it means not being passive. It could be more cash flow, it could be more returns. You're also taking on more risk because you're on your own, right? So no different than what you would do if you're going to a new city in Canada. First thing you should be doing is go choose a city, do your research, choose a city, and then call someone in business development for that city. Have a city official tell you about the city, and then go get a realtor, a wholesaler, property manager, contractors, make your contacts.
I want to go back to financing because
Mm-hmm,
when I talk to people, talk to real estate investors,
mm-hmm,
that's their biggest fear. Now you mentioned they'll look at the loan, but for years they weren't looking at your Canadian assets, your Canadian income when you were trying to get a property in the States.
mm-hmm.
So what's been the big change in, like, what would be the difference of me going to apply for a mortgage in property in Ontario versus me applying for a property in Tennessee?
Mm-hmm.
What are the lenders going to be looking for, and how will they look at the deal differently?
Mm-hmm. So first off, when going to the States, we're using U.S. lenders. We're not using any of the big banks, any of the Canadian banks. Because from my understanding, the Canadian banks will, if you're looking for a mortgage in the States via a Canadian bank, they're still looking at your personal situation in Canada. Now, again, I've owned over 40 properties. I've had I've had equity interest in about 40 properties, 40 plus properties in Ontario. So I'm well versed in what it's like to get a mortgage here. Uh, So I have to personally qualify. I have to disclose almost everything. We have to. Mortgage people hate share my wife and I because we have like 10 corporations to show them because they're asking for everything, and then we have to explain to them what's in what each of them are for with the financials, right? Versus in the states, they're just looking at the deal or your U.S. portfolio. And again, because we get such good, because we get such better cash flow, such better yields, such better cap rates in the states, it's a better investment for the lender. So of course they're going to scale you more because my debt service coverage ratio is so much higher than anything I buy in Canada.
And so you mentioned 30% down earlier. Is that a typical? They're looking for maybe as up to 70. They'll go as high as 70% on the mortgage, and or is that in the ballpark?
Just based on the deals that we're seeing, and again, we're working with Canadians. So because Canadians have to pay a premium over Americans, our Canadian clients are having to put down around 30% or more at today's rate. We're recording this October 18th.
Okay.
For an American to walk up, so also over 80% of our clients are actually American. So they all cash flow better than my Canadian clients. However, no different than anyone new to this country, you need to draw the line at some point in the sand at some point and start building credit. So in about 18 to 24 months, my Canadian clients will all have excellent credit in the States and then get similar rates to what the Americans get. And then
Okay.
they'll cash flow even better.
So
Did I answer your question?
Yeah, no, it does. So what I want to dig into that. So uh, what kind of amortization and what kind of period of time is the rate locked in for? Because we're all jealous of the 30-year amortization in the
Yeah.
States where people were locking in at 2 and 3 and 4% a few years ago. It's
Mm-hmm.
obviously not like that anymore. How long
Mm-hmm.
can you lock the rate in for, and what's a typical rate?
So even I'll take this step. Just want to go a step behind as well, because we're talking about properties like 90 grand, 155 grand, 100, 265 grand. Our renovation budgets are like between like 20,000 to 35,000 American for even off market deals that need work, right? Because the price points are so low, a lot of people can handle this with cash and home equity line. So you can do a nice and clean burr, right? Buy, renovate, rent it out, and then bring that deal to the lender to get the lowest possible rate, right? And then you asked about amortizations. Yeah, we're generally doing 30-year fixed mortgages. So the amortization is 30 years and the rate is fixed for 30 years. Now we're also advising all of our clients that we think rates will bottom roughly around 3 years from now. So all of our projected financials that we give our clients also includes a refinance scenario in about 3 years from now. Hopefully rates get down to about 4%, because right now we're seeing clients paying the sixes or sevens. Our Canadian clients, Americans pay less. But once you refinance at 4%, your cash flow goes up significantly. It's locked in for 30 years. Also, the way we are structuring our mortgages today, we're not paying breaking fees either. You can do that in the States. You can't do that here.
So I never understood that. So you get a 30-year mortgage at 6 or 7 today,
Mhm.
and then in 3 years you go, hey, I'd like to renegotiate a much lower rate for 30
Mhm.
years. What are the fees? What are the charges? What's the process?
Because we're planning for this upfront, we're actually paying slightly higher interest rates today in order to not have a break fee
Okay.
in 3 years from now. And so then we can walk. So then we have no break. We just get a new mortgage, pay off the old mortgage at a lower interest rate, lock it in, just like Warren Buffett teaches. You're basically giving someone else the bad deal while we take the good deal. And now your interest rate risk is frozen for 30 years. And if rates fall further, go do another refi. And also, generally, as well, in the States, after 5 years, there's no penalty for breaking the mortgage. Generally.
And then it's a new 30-year mortgage. So
Yeah. Go get
like
another 30 year.
even though you're 5 years in and you renegotiate or you do it again in 5 years,
Mm-hmm.
it's for another 30 years and
Generally.
locked in.
There are 15 years available, but there are less of them available for Canadians on an income property. But once we have credit, then again, it's a moving. There's a like share we pitch our clients' deals or properties to 1,000 lenders. My friend Scott that works for Lend City pitches it to 4,500 lenders. Right, so there are no hard and fast answers. Things are always changing. but but this is all way better than what's available in Canada.
Fascinating. Okay. So if we look ahead to the U.S., we're
Mhm.
talking my podcast a lot about this, about their productivity versus Canada, the money flowing into their
Yeah.
country versus Canada. If you were to look ahead at the long term U.S. real estate market, what do you see happening in the next 10 to 15 years in the U.S., or at least the U.S. compared to Canada?
Well, the UN, I saw a really nice chart by the UN. They actually have forecasts for population for the US in like 2050, 2100, which is crazy to think of that far. But the US is expected to continue to grow in population. And then with job growth, with investment in job growth, like again, their economy, there's basically no good theory for anyone to overtake the Americans as the super mega global superpower. All right. For anyone who watched that SpaceX video of them catching the rocket on the weekend, like like literally China just a few years ago when they launched a rocket, the building it wouldn't detach from the building that it was attached to. It actually took off with the building versus SpaceX had a building catch a falling rocket that was 70 meters tall. I don't know how many tons of weight it was, right? The Americans are creating science fiction like today. Anyways, so the American economy is growing, the investment's growing, their population is growing, and they keep printing money as well, no different than any other government. So, so in terms of like green lights, if you're looking down a street and you're seeing traffic lights and like the green versus red lights, it'd be tough to find a country that has more green lights, right? And that's coming from like I look at everything from an economist's perspective. Like I'm a business person. I'm looking at where will my money work the hardest for me. And anyone who's made money in the stock market, for example, the last 20 years, almost all of it's been in American companies, right? Or companies that invest heavily in the States. And I'm happy to debate this topic with anyone, but you know what? I've had this open invite for a long time, and no one's taken me up on it. Right? Some Chinese bulls have, but I'm Chinese, so I'm not allowed to say these things. But again, like their population and their youth unemployment is just scary. So again, I don't see anyone taking over the Americans anytime soon for the hyper mega superpower and also the currency of reserve. And Darren, also you're in finance as well. What financial planner, I'm talking to the Canadian investor, what financial planner in the right mind would say, hold all your hard assets in Canada in Canadian dollars? And for most real estate investors too, real estate is by like an overwhelming portion of their investment portfolio. Right? So what financial planner would say that's appropriate? And then they look at any financial planner around stocks or mutual funds, how much of that money is in the States? So why shouldn't people's real estate be in the States as well?
Great argument. Great argument. Cool. Okay. Well, I could talk about all day for this, or all day about this. So we're gonna put your social media. We got Erwin Szeto on Facebook and Instagram. We've got truthaboutrealestateinvesting.ca as the website. But Erwin, if we have people listening to this today and they wanna start learning more about how to invest in the States, or they're thinking about investing in the States, what would be a couple of strategic first steps someone could take to start educating themselves about how to invest in the U.S. and the ramifications of doing so?
I've had several American guests on my podcast. That'd be a great place to start. Also on my website that you mentioned, truthaboutrealestateinvesting.ca, like there I have free reports there as well. I have a spreadsheet where I'm tracking new U.S. manufacturing investments. It's about like 6-7 pages long, and I because there's just so much investment in the States, I have to document it. It's too hard to keep track of. Versus Canada's list is about this big. And also Darren, I should throw out there too. Like Cherry and I are planning to buy a house with our whole life policy.
Excellent.
Right, but part of it makes sense because I can get yield out of my U.S. income property to cover my interest expense. Which is basic investing 101. Have your cash flow cover your interest expense, right?
Wow, using cash value to buy properties. Now we're going to be lifelong friends, Erwin. That's fantastic. Thanks for mentioning that. Okay, anything else before we wrap up, Erwin?
Isn't that living the dream, though?
That is living the dream. I'm telling you, nice.
I know for you, yeah. For people who understand whole life.
I think these two strategies, investing in real estate and in cash value life insurance, pair well. So
yeah. Infinite banking with infinite mortgages.
All right. That's it. We'll just leave it there, Erwin. People want to learn more, check out truthaboutrrealestateinvesting.ca. Erwin, thanks for your time. Thanks, everybody. Have a great day. Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.